Welcome back to the deep dive. This week, you've asked us for something quite specific to really cut through the sheer volume of data in the latest Navigator 40 research. It covers that, well, pretty intense week, ending October 11th, 2025.
Intense is one word for it.
Right. So our mission today is geared directly towards you, our professional audience focused on capital allocation. We want to pull out the most strategic, the most actionable intelligence from that report. We're honing in on the big macro themes and, maybe most importantly, the guidance on what to actually do right now, given this pretty sharp market shock we just experienced.
Yeah, this is definitely a critical moment. And frankly, this report isn't one for casual reading. It demands real scrutiny. The central question, the tension that really frames everything in this analysis is this. Was that broad, acute global equity sell-off we just saw? Was it just a standard intermediate correction, the usual 8 to 12% pullback that kind of clears the decks? Or is this the real deal, the actual beginning of a major, potentially prolonged bear market? How you, as an investor, answer that question? Well, it dictates pretty much all your tactical moves for the next, say, 6 months.
And the quantitative evidence, the numbers, they're already showing a decisive shift from the professional side, aren't they?
They absolutely are. We always start with the quant evidence, and here the indicators have flipped, decisively bearish. We use our own scoring system, the Instat scores, tracking technical sentiment across over 1,600 instruments.
1,602 to be exact.
Right. And for the first time in quite a while, months actually, the aggregate score has turned negative, specifically 948 instruments. That's 59.2% of the whole universe registered as bearish.
Wow, nearly 60%.
Exactly.
Yeah.
This isn't just a bit of softness. It's a clear, unambiguous signal, a major shift in technical sentiment that, frankly, any disciplined investor really has to pay attention to. It means momentum, both short-term and intermediate-term price trends. They're confirming a risk-off environment pretty much across the board.
Okay, so let's unpack that, this dramatic sentiment shift. Let's start with the price action itself. The report highlights something pretty brutal. Except for one tiny, very niche area, there was basically nowhere to hide in global equities last week. That kind of negative breadth, it suggests real systemic fear, doesn't it?
It was startlingly broad, yeah. Usually in a correction, you see some rotation, right? Money flows into staples, maybe healthcare, sometimes big cap tech.
Classic defensives.
Exactly, not this time. The selling just hammered almost every sector at once. Here in the U.S., while the big indices obviously took a hit, it was the small caps, the Russell 2000, the US 2000, that really led the retreat, down 3.42%.
And that's a direct consequence of worries about interest rates, inflation staying sticky.
It is. It's a direct, almost predictable casualty of those overarching concerns.
Can you just quickly remind us why small caps are typically more sensitive here, even when the Fed seems to be signaling it might ease up?
Yeah, good question. It comes down to a couple of things. Smaller companies often run on thinner margins, that's one. But critically, they tend to carry a much higher chunk of floating rate debt compared to the big guys.
Ah, so they haven't locked in lower rates for years ahead.
Precisely. Large caps often have financing locked in years out.
Yeah.
Small caps, not so much. So when the cost of servicing that debt goes up, or even just the fear that rates will stay higher for longer, it immediately squeezes their cash flow. Their valuations get hit much harder, much faster than the mega caps. So seeing the US 2000 lead the way down like that, it's often a leading indicator of financing stress in this system.
Makes sense. And then you look at the Dow transports, often seen as a kind of bellwether for the real economy, right? Volume, goods moving.
A traditional barometer, yeah.
And they suffered acutely. We saw Matson Inc., the shipper, down over 12%, 12.29%. JetBlue fell 8.70%. That feels like more than just interest rates. It sounds like the market's pricing in higher running costs and maybe slower demand for actually moving stuff and people around.
That's exactly the implication. The transports index is vital. It measures real economic activity. When you see shippers, airlines taking those kinds of hits in just 1 week, it absolutely reinforces the market's fear. Fear that Q4 guidance, looking into 2026 maybe, is going to reflect a genuine slowdown. A contraction in industrial production, maybe less discretionary travel.
And it wasn't just those sectors. Even within the Dow Industrials, which people sometimes think of as safer, you saw big cyclical names get hit hard. Nike down 9.33%.
Yeah, reacting to those global consumer slowdown fears.
And Verizon dropping 8.75%. That's high CapEx, competitive pressure concerns.
Exactly. So when you see these broad declines hitting sectors tied directly to consumer spending, to essential services, it just strengthens the narrative that this risk-off move is driven by genuine widespread economic anxiety, not just a technical blip.
So with this broad, sharp sell-off happening, how did that play out in terms of investor psychology? The CNN Fear-Greed Index, that showed a pretty dramatic snap, didn't it? Flipped right over from greed to high level of fear.
That emotional whiplash is really interesting because it contrasts so sharply with some of the more nuanced things being said publicly by professionals.
Hmm.
The report mentions Jamie Dimon, for example.
Right.
On one hand, he's acknowledging the very real risk of a serious market event. A soft landing into a crash was the phrase, maybe in the next 6 months to 2 years. So he's clearly positioning for systemic risk.
Okay.
But almost in the same breath, he mentioned lots of merger talk, which suggests that even with this short-term panic and the long-term fear, the underlying investment banking engine, M&A, deals, capital raising, it's still churning. It suggests capital is still very active, but it's moving surgically. It's not just fleeing the system entirely.
That's the classic tension, isn't it? Retail sentiment flips to panic mode while the institutional money stays disciplined, looking for dislocations, looking for opportunities.
Okay.
The source used a great analogy, actually, borrowed from Barry Manilow of all people, to capture that feeling of bullish exhaustion. It said, now the guns are exhausted and the bullets are blanks. Kind of sums it up.
That phrase is perfect. It really captures the short-term market mood, the bullish momentum that drove the indices up to those recent highs. It just ran out of steam this week, ran out of operational fuel, you could say. It gave way to defensive, almost exhausted selling. It signals that all the good news, that resilient Q2 GDP, the hopes for an immediate Fed pivot, it was all priced in already. There was no margin left for error when the geopolitical shock started hitting.
Now, despite all this pain in the U.S. and also in Asia, Hong Kong's HK50 was down over 3%, 3.13%, amid worries about a regional slowdown, especially around property there.
Yeah, China concerns weighing heavily.
Right. But despite that, we saw some really sharp, maybe unexpected gains elsewhere internationally. This divergence feels key for anyone allocating globally.
It's genuinely fascinating. This major deviation from the U.S. trend really confirms that this was, at least partly, a rotation, not just a universal retreat from equities. While the U.S. markets were sinking, Argentina's MERV index, it surged an incredible 6.64%.
6.64% in a week like that.
Astonishing. And Japan's JP2225, the Nikkei, it posted a really strong 5.07% weekly gain. So the immediate question is, why? Why such a difference?
Okay, let's tackle Argentina first. That 6.6% move is staggering.
Argentina's surge is, well, it's a classic case of capital repositioning. It's driven by hopes around political change and potential currency stabilization. The market's pricing in the possibility of significant structural economic reforms after their recent elections.
Oh, the election factor.
Exactly. Plus, hopes for stabilizing the local currency against the dollar. If that happens, it makes their equity market look much more attractive to foreign investors searching for deep value, maybe a generational turnaround story. It's an asymmetric bet, really, on policy actually changing things.
And Japan, their market's been pretty resilient all year, hasn't it?
It has. And Japan's strength, it's driven by completely different factors, much more structural. You've got the persistent weakness in the yen, which is a huge boost for their export-heavy companies' earnings.
Right.
And you've got ongoing efforts around corporate governance reform, which is slowly making Japanese businesses more attractive to international capital. They're increasingly seen as a high-quality, geographically diverse alternative to, say, China exposure. So this divergence, it just confirms investors aren't just dumping all stocks globally. They're rotating out of what they see as overvalued or geopolitically risky in the West and into specific international markets that show local strength or momentum, especially if there are favorable currency or policy tailwinds.
Okay, let's pivot then to the macro policy environment, because that's the underlying structure, the liquidity context for all these market moves. The Federal Reserve, their stance after cutting rates 25 basis points this week, it seems decidedly dovish now, projections implying maybe 2 more quarter-point cuts before year-end.
This easing path is absolutely critical. The Fed's walking a really tricky line here. They're justifying this pivot towards easing, even though Q2 GDP growth was actually pretty resilient at 3.8%. They're justifying it by focusing intensely on the softening job creation numbers and the fact that inflation is moderating.
So they're prioritizing growth support over inflation fighting now.
That's how the market is reading it, yes. It looks like a shift to supporting growth, which firmly puts the U.S. into an easing cycle, and that potentially validates the intermediate-term correction theory rather than the full-blown bear market theory, at least for now.
And if that easing cycle narrative actually holds, well, that has immediate, very direct, actionable implications for fixed income investors, especially those holding longer duration bonds.
Absolutely. Lower expected short-term rates tend to flatten the yield curve, which supports long-duration fixed income. We saw it happen Friday. The PIMCO 25-plus year zero-coupon U.S. Treasury ETF, ticker ZROZ, it jumped another 2.6% just on Friday.
Wow.
And the report rates at a clear B. Why? Why? Because investors are aggressively extending duration. They're anticipating that yields will compress further as the Fed moves towards those projected rate cuts later this year.
Okay, and you mentioned SOFR earlier in the context of small caps. Can we quickly define SOFR and connect it to that big gold rally we saw? Gold hitting a record high.
All right, SOFR, the secured overnight financing rate, is now down almost to 4%. AGOFR is the key benchmark for short-term borrowing costs, for liquidity in the U.S. market. It replaced LIBOR.
Got it.
When SOFR falls, it signals cheaper short-term money. And critically, this lowers real yield. That's the nominal bond yield minus inflation expectations. Lower real yields make assets that don't pay a yield, like precious metals, much more attractive.
Because the opportunity cost of holding them goes down.
Exactly. And that's why gold set a new record, pushing above $4,000 an ounce. This move really validates gold's role, not just as an inflation hedge, but as a key beneficiary when liquidity expectations ease and the real return on holding cash or short-term debt diminishes.
Now, connecting this back to the global policy picture, we're seeing some divergence among major central banks in how they're actually executing policy, aren't we? The Bank of England held rates steady, but they signaled a specific dovish tilt by slowing down their quantitative tightening program. That sounds technical, but it's significant.
Well, it's deeply technical, but it's crucial if you're managing liquidity. Quantitative tightening, QT, that's when the central bank sells bonds back into the market, effectively pulling cash out of the system. The BOE just reduced its target for shrinking its gilt holdings from $100 billion down to $80 billion over the next year.
So they'll sell 20 billion fewer bonds than planned.
Right. And that subtle reduction in bond sales, it signals a clear attempt to ease some of the liquidity strain, particularly in the long-dated gilt market, which had shown signs of stress recently. It's basically the BOE saying, okay, we're holding the line on interest rates for now, but we see the market needs a bit of a liquidity break.
Meanwhile, north of the border, the Bank of Canada seems to be diverging again.
Yeah, the BBC is kind of complicating the North American picture right now. Despite all the global talk about easing, expectations for further rate cuts in Canada have actually fallen. There's now only about a 57% probability priced in for another 25 basis point cut.
And that's due to strong labor data up there.
Exactly. Stronger than expected job numbers. So it just highlights that global allocators have to manage these distinct national policy paths. You can't just paint the whole G7 with the same dovish U.S. Fed brush.
Okay, and this is where the conversation really has to shift from monetary policy nuances to the acute, critical catalyst for this week's big sell-off, the escalation in geopolitical and trade conflicts. Specifically, the U.S.-China tech war just took a massive, very material turn.
This, I think, is the single most important factor driving the acute fear we saw this week. China's Cyberspace Administration. They ordered their major domestic tech companies, Alibaba, Tencent, Baidu, to immediately stop buying specific high-end NVIDIA AI chips.
Which one specifically?
They targeted the RTX Pro 6000D and also the A800 series, which was actually a customized chip NVIDIA created specifically for the Chinese market to comply with earlier U.S. restrictions.
So this goes beyond previous restrictions.
Absolutely. This is a direct, substantial escalation. It unilaterally chops off a massive potential revenue stream for NVIDIA. And it really challenges that earlier compromise the U.S. Commerce Department had sort of allowed, where certain chip sales could happen under license. China just said no.
What are the immediate knock-on effects? And the longer-term ones?
Immediately. It throws a huge wrench into the AI infrastructure build-out plans in China, the world's second-largest economy. For the U.S. and its allies, it just solidifies this trend towards bifurcation, towards de-risking supply chains. It also raises the very real possibility of severe retaliatory actions by China against U.S. firms operating over there.
And this tech tension is happening alongside renewed trade conflict talk, tariffs looming again.
Exactly. It sits right on top of renewed U.S.-China trade friction. There's talk of significant broad-based tariffs potentially coming from the U.S. side, the threat of a full-blown trade war making a comeback, combined with this sudden tech decoupling. That's what likely caused that rapid flip from greed to fear in the sentiment indicators.
And the report also notes the U.S. administration is actively looking at a $10 billion joint manufacturing fund with Japan. Specifically for semiconductor supply chain resilience. This isn't just tit-for-tat tariffs, it sounds like strategic repositioning.
Precisely. This fund is clearly an attempt to build out a high-quality, trusted, secure semiconductor supply chain completely outside of China's sphere of influence. It confirms the U.S. strategic shift is structural, it's long-term, it's prioritizing security of supply chains over just immediate cost efficiency.
Okay, now let's connect this geopolitical risk to a specific regional allocation risk mentioned in the report, the Canadian energy sector. There's some specific uncertainty around potential U.S. tariffs on Canadian energy imports.
Yeah, this is a critical nuance for anyone allocating capital in North America. Right now, most heavy energy exports think the crude oil moved by pipelines operated by companies like Enbridge. They're currently exempt from tariffs under the USMCA agreement because they originate within North America.
Okay, so USMCA protects them for now.
For now. But the political noise has created genuine regulatory risk. There's talk in the U.S. administration about potentially raising the general 10% tariff on goods, or even, and this is the key phrase, declaring a national emergency on electricity. They could be used to impose new taxes or limits on Canadian power exports specifically.
Why would declaring a national emergency on electricity be such a specific threat? How does that work?
Because declaring a national emergency often allows the administration to circumvent existing trade agreements like USMCA and other regulatory hurdles. It could give them the power to unilaterally impose new restrictions, new taxes, or limit on power transmission, all framed under perceived national security reasons.
Okay, so it's a potential workaround.
It's a potential workaround, and that threat, even if it doesn't materialize, introduces a specific non-USMCA regulatory risk for investors heavily weighted in Canadian energy firms like an Enbridge. Even if the oil pipelines themselves are flowing tariff-free today, it just shows how political rhetoric can quickly translate into immediate, localized investment risk that might need hedging or rotation out of.
All right, let's move into performance then. Section 3 of the report really highlights that extreme bifurcation we touched on earlier. Amidst the sea of red ink and geopolitical fear, there were some absolute thematic winners, specifically AI and precious metals.
Yeah, the AMD story is just phenomenal. Advanced micro devices surging an incredible 30.40% in just 1 week, purely on AI enthusiasm.
30%.
It just confirms the market's deep, almost asymmetric conviction in that whole AI theme. Investors are fundamentally separating what they see as the true, high-conviction structural growth stories the company's positioned to dominate the next decade. They're separating those from the broader market correction that's being driven by interest rate fears or cyclical slowdown worries. It shows capital is being highly discerning right now. It's fleeing generic risk, but it's absolutely stampeding into what it perceives as genuine, unique opportunity.
But the safest haven, the one niche area that really outperformed everything else, was precious metals.
That is the clear structural outlier this week, and it's where we see the most compelling momentum right now. Gold and silver miners delivered truly exceptional returns. As gold itself hit that record high above $4,000, the miners, which basically offer operating leverage to the underlying commodity price, they just exploded higher.
And the Instat scores back this up strongly.
Absolutely. The scores for this specific industry group are substantially superior. I mean, way better than any other sector group in the entire report. That signals strength across the board. Acute term, AT, and intermediate term, INN, price momentum, are both incredibly strong here.
Can you give us a concrete example of that kind of momentum in action?
Sure. For a really acute example of this massive sustained momentum, look at the microsectors gold miners 3x leveraged ETN. This is a highly geared instrument, so it's volatile.
Right, 3x leverage. Not for the faint of heart.
Definitely not, but it's up a stunning 631.42% year-to-date.
600.
And it remains rated buy add in the report. Now, that performance, it's being fueled by two main things. One is the obvious safe haven demand during geopolitical stress, but it's powerfully amplified by those lower real yields we talked about earlier. The lower the real cost of holding gold, the more attractive it becomes, and the miners get that leveraged effect.
Okay, so that's the upside. Conversely, let's look at the key sector vulnerabilities. We talked about small caps being sensitive to rates. Where else did rising rate concerns inflict the most pain last week?
The housing sector got absolutely hammered. The iShares U.S. Home Construction ETF, ticker ITB, it plummeted 8.60%. Housing just remains acutely sensitive to the lagged effects of those previous high rates, which jacked up mortgage costs. And even with the Fed signaling a dovish turn, the damage already done to affordability and construction activity that really hit hard this week.
And high-yield bonds, too.
Similarly, yeah, in the bond space, high-yield bond ETFs like J&K, they also saw significant weakness. That just underlines renewed credit concerns starting to bubble up as recession fears resurface.
And the more speculative corners of the market, how do they react to this risk-off mood?
Predictably sharp reactions there. The crypto market saw a really dramatic sell-off. Ethereum, ETHEIST, it collapsed 16.68% just this week. That shows just how vulnerable these speculative, arguably non-productive assets are when liquidity suddenly tightens up or risk appetite evaporates.
There was an interesting divergence within crypto, wasn't there? Some related stocks held up or even gained?
Yes, that was fascinating. Certain crypto-related equities, like Riot platforms, ticker Riot, they actually diverged positively. Riot gained 8.02%. What that might indicate is that while investors were dumping these speculative assets themselves, the actual code, some might see the mining firms or exchanges as potentially resilient businesses operating in that space. Maybe they look fundamentally cheap, especially given the current cost structure advantages some of the big miners have. It's an interesting split.
And we also saw notable weakness in critical minerals. That's a sector sometimes lumped in with precious metals, but it faces very different pressures, right?
That's a really important distinction to make. Specifically, lithium miners plummeted. Piedmont Lithium, for example, dropped 18.36%. This isn't really a demand problem for lithium. The EV transition still needs it. It's more of a supply-side issue.
Oversupply fears.
Exactly. Fears of rapid oversupply hitting the lithium market, especially from new production coming online fast in places like South America and Australia. That oversupply risk contrasts sharply with gold, which is finite and driven by that safe haven demand. Different dynamics entirely.
Okay, let's circle back to U.S. small caps then, because despite that short-term pain, the U.S. 2000 leading the market down the Navigator framework seems to present a really compelling structural opportunity here.
Right, and this is where we have to really focus on separating short-term price volatility from underlying intrinsic value. The price action right now is undeniably bearish for small caps. But the structural argument for owning U.S. small caps, it's arguably the strongest it's been in a generation. They're trading at a generational valuation discount.
Can you quantify that discount for us? How cheap are they relative to large caps?
Yeah, the Russell 2000 index is currently trading at roughly a 25% discount compared to the S&P 500's price-to-earnings ratio.
25%, that's huge.
It's massive.
Yeah.
Historically, when you see that magnitude of undervaluation, it tends to signal enormous asymmetry in potential returns over the next, say, 3 to 5 years. Plus, you have the historical tendency for small caps to rebound really strongly right after the start of an interest rate cutting cycle.
Which we seem to be entering now with SOFR near 4%.
Exactly. That easing of borrowing costs is likely to disproportionately benefit these smaller, more domestically focused firms. It gives them a significant potential tailwind heading into 2026.
So the idea for investors is to look past the immediate technical damage and focus on which sectors within the small cap space might benefit first from this easing cycle and maybe from any potential fiscal stimulus down the road.
Precisely. The analysis points to 3 key areas within the small cap universe that look particularly sensitive to both fiscal stimulus and easing rates. Small cap industrials, companies involved in green chemistry, and certain specialized technology firms. Think about the big structural tailwinds, like deglobalization, the reshoring of manufacturing back to the U.S., the massive infrastructure spending bill.
Those all tend to favor smaller domestic players.
Exactly. They're set to favor these smaller domestically exposed firms much more than the huge multinational large caps that are also sensitive to currency fluctuations. This structural opportunity is what makes the current sharp sell-off potentially a very attractive buying opportunity for a disciplined long-term allocator.
Okay. And just to round out this section on performance, let's quickly revisit those international stock standouts, just to give a full picture of where resilience was found globally.
Right. So beyond those really big moves we saw in Japan and Argentina, European financials remain a key structural theme to watch. They benefited massively from the previous high-rate environment, which boosted their net interest margins.
We saw huge gains there earlier in the year.
We did. Unicredit in Italy, for instance, is still up over 80% year-to-date. Deutsche Bank in Germany is up over 100% year-to-date. Now, they did see some short-term weakness this past week, along with everything else.
Sure.
But the underlying performance is supported by a sort of modest European economic recovery and the expectation that their profit margins might hold up better than their U.S. counterparts in the near term. And then the other clear emerging market standout was Vietnam. The VNM ETF surged 8.27% last week. That reflects a really significant shift of capital towards that economy. It's increasingly seen as a primary beneficiary of supply chains diversifying away from China.
Okay, this brings us really to the core of the Navigator approach, doesn't it? The strategic framework itself and the practical, actionable guidance on how to actually capitalize on all this volatility. This is crucial for our audience looking for tactical application. So first, let's clearly lay out the core investment philosophy here, the idea of the systematic, valuation-based portfolio manager.
Right. The absolute core philosophy, it's built around one simple principle, really. The manager has to see themselves fundamentally as a contrarian business owner, not as a short-term stock trader just chasing momentum or headlines.
A business owner, not a stock jockey.
Exactly. And the central guiding principle is discipline. You buy into weakness, but only when the market price diverges significantly below your calculated intrinsic value, your fair value estimate for the business. And conversely, you only sell when the market gets greedy, when it gets euphoric, and bids the asset way up beyond its inherent worth. The whole goal is to systematically exploit these market inefficiencies, these bouts of volatility, over multi-year cycles, not day to day.
And the practical way this philosophy gets implemented, how it actually guides building the portfolio, is what the report calls the barbell strategy. Can you explain that? What does avoiding the middle-heavy portfolio mean, and why is this barbell structure supposed to be effective, especially in turbulent times like these?
Yeah, the middle-heavy portfolio, that's the portfolio killer, right? It's
Yeah.
stuffed full of average companies bought at average prices. They don't really offer much downside protection when things get rough, and they rarely provide significant upside alpha
So
either,
it's just kind of meh.
pretty much. So the barbell strategy deliberately avoids that mushy middle by balancing two fundamentally different extremes at opposite ends of the portfolio. On one end, you hold what we call explosive growth and disruptors. Think AMD, think NVIDIA in the past. These are companies aiming for truly asymmetric, potentially exponential upside. They're often volatile, high beta assets, but they offer that potential for massive growth.
Okay, so that's one end of the barbell. High growth potential, high volatility. What's on the other end to balance it?
The other end is absolutely essential for stability, especially now. It's the wide moat cash generators. These are the high-quality, incredibly durable businesses. The report refers to the internal Cara 100 list as an example.
The Cara 100. What defines those companies?
The Cara 100 is basically defined as the top 100 globally diversified companies that possess the highest combination of three key things: sustainable free cash flow generation, low debt relative to their equity, and crucially, demonstrable pricing power, what Buffett calls a wide economic moat.
Got it. Durable, profitable, not over-leveraged.
Exactly. These businesses provide the survival mechanism for the portfolio. They generate the durable cash flow needed to weather downturns and provide stability when that growth side of the barbell inevitably experiences high volatility. So it's that combination, the potential for alpha generation on one side, balanced by downside stability and cash generation on the other.
Okay, that makes sense. So if the core philosophy is primarily valuation-based, buying based on intrinsic value, where do technical indicators like the InStat scores we talked about earlier fit into this process? Are they the main signal to buy or sell, or are they more about timing confirmation?
They are purely decision support and maybe probabilistic triggers for timing.
Yeah.
They are absolutely not the primary trading signal. We would never, ever buy a fundamentally poor business just because its technical chart suddenly looks good. That's backwards.
Right.
Technical indicators are used to help time the investment opportunity after the fundamental value proposition has already been established. The InStat components, the 8T for acute term, ST for short term, IN for intermediate term scores, they help confirm the current price regime. Right now, they're confirming a bearish regime, which validates the tactical move towards a more defensive posture. So, when you find a good company whose price is below your calculated intrinsic value, and the technicals are signaling widespread fear, like that 59.2% bearish reading, well, that's often the signal that the time to act is approaching.
And point and figure charts, the P&F charts mentioned, they play a specific role in cutting through the day-to-day noise.
Absolutely. P&F charts are really useful for generating clear, objective signals because they filter out all the minor daily volatility. They only register significant price changes. For instance, the report noted that the NYA, the New York Stock Exchange Composite Index, confirmed a new downtrend this week by decisively breaking below its double bottom support level on its P&F chart.
Okay. A clear technical break.
A very clear objective signal that confirms a structural shift might be underway, a change in the intermediate-term trend. And that strongly supports the tactical decision to, say, increase cash reserves and adopt a more defensive stance right now.
Okay, so let's get to the bottom line then. Given this massive bearish pivot in the technicals, the geopolitical uncertainty, what does this actually mean for portfolio allocation right now? What's the core actionable guidance coming out of Navigator 40 this week?
All right, given the clear interim weakness and that decisive bearish shift in the Instat scores, remember, almost 60% of instruments flashing negative. The current strategy recommendation is to increase the cash position. Specifically, the guidance is to move from the previous 30% target cash allocation up to 35% cash.
35% cash. Isn't that potentially overly conservative, especially if we are expecting rate cuts down the line and maybe that small cap recovery in 2026 we talked about?
That's the critical tension you always have to manage. It's not about being purely conservative just for the sake of it. It's about maximizing optionality, maximizing dry powder. We increase cash now specifically to allow for selective, opportunistic buying over the next, say, 30 to 60 days, especially if this intermediate correction deepens further, maybe into that 10–12% pullback range. So this defensive posture, raising cash, it's deliberately combined with very targeted rotation.
Okay, so where should allocators be looking to deploy capital selectively? Even in this heightened risk environment, where are the potential buys?
The rotation should really prioritize fundamentally sound, undervalued stocks, but specifically in sectors that are demonstrating either sustained momentum or clear structural resilience. The report highlights three areas: utilities, financials, and what it calls resilient technology.
Why those three?
Well, utilities offer those recession-resistant dividends and stable demand. Financials, particularly in Europe, as we discussed, still offer strong year-to-date performance and potentially more stable margins than U.S. banks right now. And resilient technology, think those high-quality, wide-moat companies like the Cara 100 constituents, perhaps those will likely be among the first to recover strongly when sentiment turns. So the approach is selective buying on dips in these quality names, always adhering to that core valuation discipline.
And conversely, where are the hard sell or avoid recommendations? Where should allocators be actively reducing exposure right now?
You need to decisively cut exposure to the clear laggards and those high-risk speculative assets that are most vulnerable to both potentially higher for longer rates and this heightened geopolitical risk. That definitely includes high-yield bond ETFs. J&K was mentioned. Also, the Simplify High Yield ETF, CDX. They're highly sensitive to credit spreads, potentially widening in a slowdown.
Right.
Also, reduce exposure to those acutely interest rate sensitive sectors like home construction, the ITB ETF. And given the major catalyst this week with the NVIDIA ban, significantly reduce exposure to certain Chinese tech names directly impacted, like Alibaba, which plummeted 15.44% this week. And finally, trim exposure to those critical minerals facing clear oversupply issues, like the lithium miners.
Okay, so the overall theme sounds like preserve capital by increasing cash, but stay alert. Pair that defensiveness with opportunistic, disciplined buying of structurally superior assets, whether that's long-duration bonds like ZROZ, the outperforming gold miners, or maybe high-quality small caps if they reach those generational discount levels.
That's it exactly. Discipline and independence. They're really the only non-negotiable elements in an environment like this. Market fluctuations, volatility. They aren't risks to be feared blindly. They are potential opportunities to be systematically exploited, but only when prices get fundamentally out of line with intrinsic value. That, I think, is the absolute core takeaway from Navigator 40 this week.
Well, thank you for decoding what is clearly a very complex environment for us. We've covered a lot: the macro pivot, that critical geopolitical shock, the frankly stunning outperformance of gold miners, and those immediate tactical portfolio adjustments needed to navigate the weeks ahead.
My pleasure. It's certainly a dynamic period. But before we wrap up, I do want to leave you, our listener, with maybe one final thought, something that builds on our discussion about gold and currency control.
Okay.
We noted gold is hitting new highs, right? It's being validated again as the ultimate non-political, non-sovereign asset, sometimes called the rock. At the very same time, we see central banks all around the world, the Fed, the PBOC in China, the ECB, pushing really hard for their own central bank digital currencies, CBDCs.
Right, government-controlled digital money.
Exactly. And these CBDCs, let's be clear, they are designed explicitly to solidify sovereign control over currency, over its issuance, its circulation, and ultimately over global payment systems. So you have this inherent conflict brewing
Between government digital paper currency and non-sovereign digital assets like Bitcoin, the code.
That's the ultimate tension I think is worth tracking long term. Given this aggressive systemic push by governments, by sovereign entities, for digital control over money, for better management of foreign exchange, this push to digitize traditional paper currency, how long really will non-sovereign digital assets like Bitcoin be permitted to operate freely and, importantly, at scale within the established global payment systems? Does this accelerating shift towards government-backed digital currencies fundamentally change the long-term risk profile for cryptocurrencies, especially given their lack of, well, fundamental backing? And if it does that evolution simply enhance the irreplaceable, maybe enduring value of gold the rock as the ultimate non-political store of wealth, the asset that operates entirely outside the system of sovereign fiat control? That's the big strategic tension, code versus rock versus paper, worth keeping an eye on as we move toward the end of 2025 and beyond.